In this video, traders, we are going to look at selling a call option. Stay tuned. Hey traders, warm welcome to you. So, selling a call option, different from buying a call option, well, obviously, but there's a distinct difference in the outcome depending on how you're positioned. So buying a call option, just as a reminder, gives you the right but not the obligation to purchase a specific underlying, we'll call it a stock in this example, at a specific price at a specific time in the future. So if you're buying a $100 call option on stock XYZ expiring in July, it gives you the right to buy XYZ stock at $100 at July. Right, not the obligation. If you're selling a call option, you are taking the other side of that deal. Now, if you remember, with a call option, you've got unlimited upside and capped downside. So the most you can lose when you're buying a call option is the price you've paid for that option. Doesn't matter where the stock goes, you never lose more than that. If it goes off to the stratosphere, however, you're going to make the difference between the purchase price and the expiry price of the call option. All very well and good. Right, so you might be thinking, okay, if I take the other side of that trade, then I've got unlimited risk. And you'd be right. If you're selling a call option, you have limited profits but unlimited risk. Now you might say, why on earth would I want to do that? Well, by selling a call option, you are basically getting the premium that the buyer pays for that option. You're selling them that contract on the hope that it'll expire worthless. You want that to go to zero because you're effectively going short on that call. You want it to expire worthless. And the good thing about doing this is that if the stock doesn't even move, you still get the full value of the call option. The downside, of course, is you can lose a lot of money, but it's a kind of scale, isn't it? On one, like everything in markets, guys, what you give with one hand, it takes away with the other. So let's look at an example and let's kind of see how this might work in the real world. So why would you sell a call option in the first place? The first time you do it is if you're bearish on the underlying. So you think that this stock is going to go lower, and also you're bearish on volatility. So in other words, you think that the option is really quite highly priced for what it is. You think perhaps the stock is going to shrink in volatility and or it's going to fall lower. In both those terms, it's fine. In actual fact, if volatility doesn't shrink, but it still goes lower, you make money. If it does shrink, then you're going to make money quickly. You have to wait till expiry. Won't talk about that now. We want to talk about what happens at expiry. So if we just imagine this is if we're bearish on a stock and we think the price of the option is overpriced. And so we might do this instead of buying a put, which would give us still a bearish view, but unlimited upside, but we'd have to pay a premium for that. So let's have a look at an example and hopefully it'll all become clear. So let's look at a scenario now. We have XYZ is trading at $100, okay? And we want to sell a call option. So we sell one call at $100 strike price for $10. That's the price that we're going short at. So the buyer, if we think of it the other way around, the buyer who's buying this call option wants the right but not the obligation to purchase XYZ stock at $100 at whatever expiry we've chosen for this. And he's paying $10 for the right to do that, for that contract. And we're saying to him, okay, we'll take the other side of that. We'll give you the right but not the obligation to buy that. $10, thank you very much. We take the other side of the deal. So what happens with different expiries? So let's have a look. So if let's say we're currently trading at $100, if we expire at $100, what happens? So this contract, what is that worth? The contract that says, hey, I got the right but not the obligation to buy something at 100 that's currently worth 100, what value has that got? Nothing. So that's good for us because we've sold that at $10. The value of it is zero. And so we've made the full $10 on the deal because the price hasn't moved anywhere. It's got no value. The contract we have made as maximum amount of profit. That's our maximum amount of profit. You can see on this graph, we're up here at 1,000. And you can see if we go down the stock price, and this is stock price here. Should have put that on. So that's our stock price here. And this on the other axis, the y-axis, is our P&L. So if we went to $50, say, let's say thing halved in value, went up to $50. Again, we have a contract that says I've got the right, but not the obligation, to buy this stock at $100. It's currently trading at $50. Where's the value in that? Zero. Right, so we've made the full amount. It's expired, completely worthless. We've again made the premium that we received for that call $10. And I put 1,000 here because we're multiplying it by 100 because it's 100 shares. One contract is 100 shares if we're trading options. So that would be our P&L if we're trading one contract. Right, so now what happens if it goes against us? So if it goes against us, let's say the stock price rises and lifts up to 110 bucks. What happens? So 110 bucks, the contract is a right, but not the obligation to purchase XYZ stock at 100. It's trading at $10. That's got some value, right? It's got the difference between the expiry price and the strike price, $10. Okay, well, that's not the end of the world for us because we sold it at $10. It's got $10 worth of value. What's our P&L there? Zero. The guy who bought it is going to exercise that. He's going to say, right, okay, I will exercise that because that contract's worth $10. But actually, you sold it for 10. He bought it for 10. He's made no money. You've made no money. It's a zero outcome for that one. Right. Let's have a look at a little bit further against us. So this is starting to move against us now. $120. What happens there? Well, going back, we're summarizing, what's the value of that contract? The contract value is $20, right? Because the right to buy something at 120, it's currently trading 100. It's got $20 worth of value, but we sold it for 10 and it's worth 20, so we've lost $10 on that deal. So that's the point where we're starting to lose more significant money now. The guy who bought that's quite happy, but we're not because we've received the premium, but we've also had to pay out 20. Received 10, we had to pay out 20, so we're 10 down. Now if we look at it goes to 150, say, let's say the stock really starts to rip up and we're really wrong on this. What's the expiry? The expiry is 150. What's the value of that contract? The $100 call option is valued at 50 bucks. So we've got the right to buy something that's at 150, at 100, $50. We received 10 for that contract, but unfortunately we've got to pay out 50, the difference between the two. That gives us a net loss of $40. And you can see how this will continue higher and higher. We have uncapped risk. This could go up to 1,000, whatever it is. I mean, unlikely, but this could happen theoretically. So we are on the hook for unlimited risk. But the advantage is our break even is much lower, and we have, depending on where we're starting to sell the call option, we've got a higher probability of receiving some profit on the trade. If we're selling a call option that's well out of the money, i.e. low chances of the price ever getting there, then we've got a very high chance of receiving that premium for it. But just like everything, there is a slim chance the stock could get there, could go all the way through it, and we could be on the hook for a significant loss, especially in terms of risk reward. If we're selling a call option for $1, say, and then we're getting like $100 back, and this thing then suddenly goes way over like $100 away, we are in serious loss. So that is one downside, but the upside is that you're getting, people do this to achieve income in inverted commas. You know, if they're selling call options at the right strike price, they're going to receive income because they're just literally writing options. Another way of selling a call option is by writing an option. And they're hoping that the price never ever gets there. But of course, when the time it does, then they have a big loss, but they make lots of small wins that make up for it. So it's really, you know, again, in trading, there's always, you know, a scale to be had in terms of risk reward ratio and in terms of probability of success. If you're selling a call option that's way out of the money, your probability of success is very, very high. Your risk reward ratio is very, very poor, but it makes up for it. And so you're trying to work those numbers in your favor as opposed to somebody perhaps who's buying a really far out of the money call option. The probability of them making any money is very, very slim, but the risk reward ratio is huge. And so that's the payoff that you take. So that's selling call options, guys. You're bearish on the underlying generally. You've got limited profits, you've got unlimited risks, and it involves selling a call to somebody who wants to buy the call. And this is the kind of payout chart that you get if you're selling this call option for XYZ stock trading $100, and you sold one call option, $100 strike for $10. Anyway guys, selling call options. Take care. Whatever you do, bye-bye.